What moves your market? Different assets respond to different fundamental forces. Knowing which factors impact your specific trading instrument helps you focus on the right information at the right time. Markets respond to different types of fundamental forces: macroeconomic, affecting entire economies; microeconomic, affecting specific sectors or companies; and supply-demand factors, affecting availability and consumption. Let's explore what drives each major market. For different assets, some factors matter more than others. Can you guess which fundamental factors have the strongest impact on each market type? The Federal Reserve just increased United States interest rates by 0.25%, higher than the expected 0.15% hike. On the same day, several United States companies reported strong earnings. Which factor is most likely to have a direct impact on the United States dollar against the Japanese yen?
Yes, you're right.
Exactly. Interest rate decisions are often the primary driver for currency pairs. When the Federal Reserve raises rates more than expected, the United States dollar becomes more attractive to investors seeking yield. This creates direct buying pressure on the United States dollar against the Japanese yen, as investors buy dollars and sell yen to capture the higher interest rate. For foreign exchange traders, the following factors usually matter most. 1. Interest rate decisions and expectations. 2. Inflation data, which influences future interest rates. 3. Economic growth indicators such as gross domestic product and employment reports. 4. Trade balances and government policy changes. 5. Overall market risk sentiment. It is important to watch the economic calendar for these key events, as they often drive movements in currency values. A company reports quarterly results. Revenue is up 8%, while analysts had expected a 10% increase. Profit margins improved to 42%, which is above the 40% expectation. There was also strong growth in services. The Federal Reserve also cut interest rates today. Which factor is most likely to move the stock price today? Both equally important: overall market sentiment. The mixed earnings results. The Federal Reserve rate cut.
No, the correct answer was
The mixed earnings results. While broader market factors like Fed decisions affect the entire market, they typically don't override company-specific results on earnings day. For individual stocks, company-specific earnings results typically drive the largest price reactions, especially on the actual earnings day. Individual stocks respond most strongly to company-specific factors. Earnings results, revenue growth, profit margins, product launches, and management changes drive the biggest price moves for most stocks. Time for a quick quiz. Bitcoin suddenly jumps 15%. On the same day, a major payment processor announces Bitcoin integration, the Federal Reserve raises interest rates, and stock markets fall. Which likely caused Bitcoin surge? Stock market decline. Fed interest rate increase. Purely technical breakout.
Yes, you're right.
Right. Major adoption announcements, such as integration with a payment processor, often drive the strongest price movements in cryptocurrency. In earlier phases of Bitcoin's evolution, adoption news frequently triggered the largest rallies. For example, when PayPal announced in October 2020 that users in the United States would soon be able to buy, sell, and hold Bitcoin, the price of Bitcoin surged by approximately 10 to 15% in the following days. Cryptocurrencies respond to a unique set of drivers. While they share some similarities with traditional assets, factors like adoption news, regulatory developments, and technological updates often create the most significant price moves. For cryptocurrency traders, these factors typically matter most. 1. Adoption milestones such as institutional buyers or payment integration. 2. Regulatory news, including government policies and decisions from the Securities and Exchange Commission. 3. Technological developments like upgrades or network forks. 4. Overall market sentiment and liquidity flows. 5. Macroeconomic factors such as inflation and investor risk appetite. Monitoring cryptocurrency-specific news sources is essential to stay ahead of these market-moving catalysts. The Organization of the Petroleum Exporting Countries, along with its allies, known as OPEC+, announces a surprise oil production cut of 1 million barrels per day. On the same day, weak global economic data is released and the stock market declines. Which factor is most likely to move oil prices today? Stock market decline, weak economic data, technical support levels, the OPEC plus production cut.
Yes, you're right.
Correct. The OPEC plus production cut directly reduces oil supply by 1 million barrels per day, creating an immediate fundamental imbalance. Supply reductions of this magnitude typically outweigh other factors in the short term, as they directly change the physical oil available in the market. Commodity traders focus primarily on these supply-demand shifts. Commodities respond most directly to supply and demand fundamentals. Production changes, inventory levels, weather patterns, and consumption trends drive prices for oil, metals, and agricultural products. Knowledge check. Match assets to their primary drivers. Different assets respond most strongly to different fundamental factors. Match each asset with its most important price driver. You now know what drives each major market. While all assets respond to multiple factors, focusing on the most relevant drivers for your specific instrument will make your fundamental analysis more effective. Apply this knowledge to any market you trade.
What is the primary purpose of fundamental analysis in trading? Create complex chart patterns. Track historical price movements only. Find support and resistance levels. Study economic factors that affect asset prices. What principle explains why the Euro-USD might fall when ECB signals lower rates? Every price move has a reason. Technical patterns always prevail. Random market fluctuations occur daily. Chart indicators determine all movements. What relationship best describes fundamental and technical analysis? Fundamentals explain why. Technicals show what. Neither approach provides trading value. Fundamentals replace the need for technicals. Technical patterns predict fundamental news. How do markets typically react when data comes in worse than expectations? Markets show no reaction. Asset prices always rise. Asset prices usually fall. Only technical factors matter. Two. What is the best response when an unpredictable event shocks the market? Reassess exposure before reacting. Follow only technical signals. Immediately enter new positions. Ignore the event completely. Three. Which asset is most directly affected by production cuts and inventory levels? Currency pairs, commodities like crude oil, technology stocks, government bonds. Four. For individual stocks, what typically drives the largest price reactions? Federal Reserve decisions, currency fluctuations, commodity price changes, company-specific earnings results. Five in a row. What most powerfully impacts cryptocurrency prices? Interest rate changes, manufacturing data, adoption and regulatory developments, Employment reports. Six. Which principle explains why markets react similarly to recurring events? All price moves are random. Some factors cannot be predicted. Every chart pattern has meaning. Market reactions are predictable. What does combining technical and fundamental analysis help traders achieve? Trading exclusively on breaking news. Creating more complex chart patterns. Understanding both what happens and why. Ignoring market fundamentals entirely.